Good evening, everyone, and welcome back to another edition of IslandMint's weekly trading activity walkthrough. So we have in front of us here a chart of the S&P 500 index, commonly known as the SPX, as you can see here. And on our chart, we have a 5-day, 15-minute chart, which means that the area that you can see in front of you on this chart represents 5 days of trading activity, whereas each of these candlesticks represent 15 minutes of activity. So on Monday, I came into the market looking at what was going on and basically saw that I may have had an opportunity to just generate a bit of cash flow. And so the market opened down from its previous close, came down to test prior support, and then began working its way very quickly upward into what I suspected was resistance at around the 2560 area. Now, you can see it clearly on this chart, so let me zoom back out to a 10-day, 30-minute chart so you can perhaps see this a bit better. Let's go to 20-day, 1 hour. So, as you can see on Monday, this period right here, we were coming into some existing resistance from all the way back here, this prior area of consolidation. So my estimation was, even though we have clearly seen this bounce up, this period of consolidation, a slight pullback into the moving average, and then a rally off of the moving average, I suspected that we were coming into an area of resistance right around the 2560 mark. And let me just quickly demonstrate what I'm referring to. Put that price level there for you. Where are we? Arrow, time level. Let's just use a quick trend line. So at around this area here, at around 2560, which you can see was a prior level of support, turned into resistance. Now, from your prior experience with support and resistance, you'd know, generally speaking, that when price comes back to a level that it has been before, it can either act as an area of support or resistance. And so because of these three touches, price came down to 2560 and bounced, came down at 2560 and bounced, came down at 2560 and bounced, came down and broke, and then a lot of price action in and around this area. I suspected that on this ramp up into the 2560 area that we would experience some congestion before we were to make a move higher. And so because I suspected that, I went to the weekly options and chose the SPX weekly option. Let me change this to a 5-minute chart so we can go play by play as it was happening. The weekly option that would expire on Monday. So what I hypothesized is, seeing that I expected resistance to come in at around 2560, I sold a call at 25.65 and bought a call at 25.70, which is known as a short call spread. So I sold a short call spread expecting that the 25.65 level would not be breached, and if it was breached, it would not end above 25.65. So looking at my trading activity here, I see that I sold the 25.65, 25.70 call spread for approximately a credit of $1.55, which equates to $155 per contract, and I sold 2 contracts. So my full credit was $310. So that would mean the maximum profit I could make on this trade if I held until expiration was $310. However, let's see how the trade turned out. So as you see price approach this 25, it broke through this area of consolidation around 25.50. Once it broke through that level, I had to be on alert. I had to be on alert because I knew the next level would most likely be 25.60. So I actually got into this trade at 12.28. So right as it breached the 25.60 level, because again, the hypothesis is this area is going to produce some slowing of this momentum because of the prior consolidation that we saw many days ago. So I entered the trade at 12.28, and I had to take some heat for a bit. As you can see here, for the next hour or so, price actually broke up and through 25.60 and only began to slow again at the strike that I was short, 25.65. So actually, I believe I was down on this trade at around $100 or so, as price moved towards and through my 25.65 strike. In fact, if you can see here, the high on this candle was 25.66. So price actually moved through my short strike, which meant my short strike became in the money, which with only about let's see, 3 hours to go or so, made this a losing trade at that time. However, based on my risk management principles, I only had 2 contracts of this trade, which meant that my loss was already limited, and I was comfortable accepting the risk of holding the trade, knowing that because of the price that I received for the trade of 155, this would have had to go through at least 26.70, 25.67.50 for me to lose if I held it all the way to expiration. Of course, my plan was not necessarily to hold it all the way to expiration, because the market has been so volatile lately, both on the upside and on the downside. I was just simply looking to scalp, i.e. hold for a short period of time until the trade turned into my favor, and then sell for a profit if I could. So very shortly after price consolidated, attempted to push through this 25.65. It had a high here of 25.66.15, high here of 25.65.83, high here of 25.66.16. So it was trying to break that 25.65, that 25.66 level for about 15 minutes and could not succeed, and eventually started to lose some strength over the course of the next 15 minutes, and then had a big down bar. And I actually closed that trade at 2:08. So approximately 1 hour and 50 minutes later. So let's look for that time. right here. So I held through this downward push that initiated the downward momentum, and I was looking for a slight bit of consolidation before I see a spike lower for which I would sell into, and that effectively came, and I sold in to that downward spike, covering that trade at 70 cents. So what that means is I received 155 per contract, or for a total of 310, and I bought the two contracts that I sold back for 70 cents. So I bought them back for 140. So I made the difference between 310 and 140 on that trade, which was 170. So that was a quick scalp on the SPX on Monday afternoon. Now, what I've noticed in my own experience, and for those of others, this is just a bit of a tidbit and a trade secret here, possibly, is that when you see intraday momentum, you should not necessarily, without strong evidence, without a strong variables going in your favor. For example, the market is tanking and that particular stock is just strong. So you're under the assumption that at some point that stock is going to go with the broader market. You should not short very early in the day, because that's when strength is most displayed. However, coming up to the lunchtime interval between 12 and 1, in fact, I would say closer to 12:45 and 1, stocks usually make their high, will test their high for the next 15, 20 minutes, 25 minutes to see if it can go higher, and then experience an impulse of downward momentum at that time, and have what is called an inventory break, a sharp search for buyers downwards, and if it finds it, then it begins to move upwards again. In fact, one of my other trades later on in the week is a clear example of this that we'll go to. So that was SPX on Monday. Then we have Netflix, which has, simply been probably the strongest issue for the start of the year. Let's take a wider look at what has been going on in Netflix. This is a 20-day 1-hour chart, and then I'm going to go to a 1-year daily chart. So Netflix, from a high of 423 in July of last year, has drifted all the way down to a low of around 230 at the end of last quarter in December, exhibiting sharp downward momentum from the start of October, when the wider market began its sell-off. So Netflix decreased by almost 50% in a period of a few months, whereas since the beginning of the year, the ending of the year into the beginning of the year, it has bounced and shown incredible market-leading strength. Literally, it has had 1, 2, 3, 4, 5, 6, 7, 8 straight up days, and these are not up days that are messing around. These are big bars which demonstrate an expansion of range, which demonstrate strong demand in one direction. You see that there is no area of consolidation. We would call this probably a V reversal. You have a sharp incline down, and now you're having just as sharp of a recovery upwards. But as I looked at the chart, I saw that again there was some congestion around this area, and I said to myself, okay, I'm gonna give Netflix a chance to get to that area and then try to put on a short trade to capitalize on either a slowing momentum as a result of that resistance area, and or sharp selling as a result of coming into that prior price region. And so let's see how that turned out. On, let's see, what day was that? On Wednesday. Yes. Let's go down to 5-day 50-minute chart. On Wednesday at approximately 2:16, so we can just zoom into Wednesday here and change it to a 5-minute chart so you can see it better. I theorized that I would sell the 325 332.5 call spread. What this means was that I expected resistance to come in at around, as you can see, Netflix was hovering around this 318, 319, 320 area for quite some time. And so I suspected that because of how many days it has been up and the prior strength that it had displayed, that perhaps it was in need of a rest. And so I was looking to capitalize on a short-term downturn in momentum that would allow me to take some quick gains on a short. However, Netflix had other ideas. Let's take a look at what happened. And so at 2:16, which is here, as Netflix pushed up, attempting to break out of this 320 level, I went short. I was looking at it, looking at this very, very tight consolidation, which, for all intents and purposes, I must admit, is very bullish. After having made such a great run-up, it is very bullish that Netflix would have this very tight intraday consolidation, i.e., people were accepting price at that level even after such an incredible run. But I was not playing for keeps, I was playing for a scalp. And so as it pressed up into 320, I went short and I was filled at $2.18 or $218 per contract, and I sold short 2 contracts for a total of $436. Now this is on a Wednesday. Price drifted down soon thereafterwards, but I was not satisfied with my percentage gain. I believe it was something like around $40 or something to that effect, and I was looking for at least probably half of the credit that I received, which would have been around $150 to $200. Netflix spiked into the evening towards the 322 mark, but came back down again to close at around 320. So what happened here? It broke above the resistance temporarily, but came back down and rested atop it. So I said to myself, okay, well, maybe this is a false breakout because it broke out only for a few minutes, a relatively short time, and came back down to its prior area of consolidation. That gave me the confidence that even though I was, I believe I was maybe 1% down on the trade, which is effectively flat, I decided to give it another day to take and watch to see what would happen. As it turned out, funny enough, this day the next day, Netflix opened down when the market was actually very strong. The market was strong, but Netflix was weak. So I was thinking to myself, yes, okay, well, this is good, because that means if the market weakens, then Netflix is going to weaken as well, given its weak open, it's relatively weak open compared to what the market was doing. However, Netflix being a leading issue had other ideas, and so people who have been looking to get into Netflix and did not get into this area of consolidation, did not get into this area of consolidation, took this 2 or 3% dip, and it was immediately bought up. So whilst I had a very good opportunity to exit the trade for close to maybe 30 or 40%, at this stage, not being quick on the draw, Netflix actually ran all the way from a low of around 313 all the way to a high of 325. So essentially, it broke through the last day's prior resistance, which caught me off guard because of the strength with which it did. It didn't consolidate as it did here and as it did here. It literally broke straight through, which caught me off guard. So now I began to say, okay, well, listen, man, I am just looking for an opportunity to exit this trade. I am looking for an opportunity to exit this trade. And so when I saw 325 was tested, it came down, was tested again, and did not break through, that gave me the confidence to try to hold the trade for a bit longer because time is on my side. I knew that with the amount of credit that I took in, even if I took this until expiration, I was okay once it did not go through 325. But because of the unusual strength and the ferocity with which it attacked that 325 level, I began to be less confident in my thesis of 325 holding. And so what I did was, at approximately, let's see, 339, I exited the trade right here for a debit of 2. Sorry, not a debit of 2, for a debit of 2. So I would essentially call this a flat trade because I entered for $218, but I exited for 200. So effectively a gain of $18 per contract times 2 is 36. After commissions and fees, which is probably about 20. So I would call this a break-even trade or a scratch. And so that was the second trade that I attempted for the week. Next up, we have Cigna, which is a leading healthcare insurer in the US. And let's take a wider look, first of all, what's been going on in Cigna. So again, from a high of 226 that was made on December 3rd. So we have a really, really nice uptrend in place here in Cigna, showing really nice strength. And that all fell apart in December as the wider market fell apart as well. We have a clear downtrend here in place. Very sharp downtrend. Which has been broken by this recent consolidation. So because of its strength going into the end of the quarter, it has attracted my interest along with significant upside option activity, call activity. And so I decided to keep a look on this, and I noticed, if we zoom into the 10-day 30 chart, I noticed this very bullish hold of this support area at around 184. That got my attention. So I said to myself, against this 184, 185 level, I would try to get long. And so that's effectively what I did. As this consolidation area continued to rise, i.e. prices were being accepted higher and higher, I was looking for a breakout of this region at around 190. So let me show you what I mean here. I was looking for price to leave this region down here. It attempted to break on this day, fell all the way back down, but came to end the day at the top of the region. So my hypothesis was, okay, this thing is looking like it's ready to break out. It's looking like it's ready to go. It's looking like it's finally developing some momentum. And so what I did was, again, on Wednesday, Wednesday wasn't that great of a day in terms of my timing. But let's go to the 5-minute chart so you can see what I was seeing. And you can see I have a line drawn here because I was looking at this line possibly being a support area for the rest of the day if the stock indeed wanted to continue going up. What happened was I bought Cigna 4 calls, 4 of the 195 strike calls for a price of $2.10, so i.e. $210 per contract. So for a total of $840 for the entire position, anticipating that Cigna would have continued upwards breaking out. However, the market was pretty weak that day, and so instead of breaking out, all Cigna did was actually fall back into its prior area of consolidation. Because I had a lot of time on the options, I decided to let this stay for a while. So at one point I was down at least about 30% on the trade, but because I had confidence that this area would hold because of the prior price consolidation, I held it overnight to see what would continue happening. So that patience was rewarded. On Thursday morning, price again opened up into that 189, 188 area, held, and continued gradually working its way upwards. And so I said to myself, okay, all right, I had about a 10% gain at that time, but that's not the type of gain that I'm looking for this particular position. And so I said, you know what, I'm going to continue to hold for at least between 40 to 50% gain. As it were, on Friday, it opened sharply down, but had an immediate reaction into coming back into this prior consolidation zone. It came to touch the very top of the zone, as you can see from this line, and bounced off of that immediately and pushed strongly higher upwards. So at that point, I'm thinking to myself, if this is the beginning of a first trend day, i.e., there would be no ducking and weaving up and down, bouncing around, and indecision, and this was a day that there was strong demand and buying. Usually, a trend day ends at the high or the low, depending on which direction the trend is in. So in this case, because I was expecting the stock to go up, on a trend day, that means that the high of the day would actually come towards the end of the day rather than the beginning, or sometime, early in the morning. And so that's what I was looking at for the entire day. I was looking to see how strength would continue to beget strength and look for a place to exit. So actually, the high of the day was made at around 11:40. So just before noon, it weakened, continued to weaken, bounced around, and just marginally ended higher. However, because my option had 1 week to go, And when you're using options, you always must be aware of time decay, especially if you're long options. Uh, the week going into the expiration of the option, in this case, I only had 1 week to go. Almost a third of the value is lost as a result of that Saturday and Sunday passing before the market opens on Monday. So my thinking was, you know what, I'm up with a gain at around 40-50%. Let me accept what the market's gods have given me that day, take my gain, and go home. So I actually exited that trade at 267. From a buy of 210, I exited at 267. So a difference of 57 per contract, which was almost $240 in gains. And so I exited at, let's see, 245, which is at around here. As it pressed up into that 194 level, I exited right here for 267. So I think that was a fairly decent trade. As this market environment goes, I will be looking to enter Signer again, possibly on Monday or Tuesday, if I get a pullback into this region. Basically, any pullback into prior consolidation, I'm going to look to be a buyer of, to see continuation going upwards. So now we move on to another trade that I had on Friday in Google, parent company Alphabet. And I'm going to explain to you my thesis on this. Now, I'm actually bullish on Google because it has earnings coming up fairly soon. It is in a confirmed downtrend, as you can see, connecting these highs. However, since the market has blasted higher, it has followed it particularly well. Not as strong as Amazon or Netflix, but I like the sort of easygoing volatility of Google that sometimes makes for some impressive trades. And so what I was looking at coming into this week, let's go to the 10-day, 30-minute chart. I noticed that the value area in Google was higher at around 1074. So due to all of this price history up to a high of 1093 just on Tuesday, came down, that 1074 level was defended, attempted to go over 1090 one more time, that level was defended, came down into 1074 again, tried to break up into 1090, that level was defended. So Google has been in a pretty tight consolidation. So when I saw on Friday morning it had broken underneath its most recent area of consolidation, I began to look for any signs of bullish intervention, i.e. dip buyers. And so let's go drill down to a 5-minute chart now and look at what's taking place on Thursday and Friday. And so once I saw Google open and continue to press down, I began to look at the strikes. 1065 was the low. 1065 was the low of the week. And it broke that fairly early. Within its first 50 minutes, it broke that. And so I knew to look for continuation of that move downwards. But because overall the market at that time was showing very little tendency of wanting to continue breaking down, it had opened down, but held its ground. Let's just take a quick look at the SPY to demonstrate this. So this is what the SPY was doing. The SPY again opened down, pressed lower, but began to hold its trading range. So this gave me confidence that if Google were to do anything close to what the overall market was doing, I should not be expecting much follow through on that downward momentum. And so what I did was look to get into a trade near the low, anticipating that the low would hold and I would be able to make some money from time decay as the day progressed. So that's exactly what happened. I was filled at 10:52. Let's see where that is. Yeah. 10. So I saw this big push momentum come down. The low was made here at 10:56. A lot of people would have been stopped out on the break of 10:60. So you see this large downward bar, yet it was not able to go to the next strike at around 10:55. So what I did was I sold the 10:50, 10:42 and a half put spread, anticipating that 10:50 would hold. Oh, in fact, I was wrong. Not the 10:50, the 10:55. 10:55, 10:47 and a half put spread. I sold that for, let's see, I sold that for $2. This is a 7.5 wide strike put spread, put credit spread, and I got a credit of $2. Now, taking in consideration that there are only at this point about 5 hours left in the day, if so much, that was not a bad credit at all. What that actually enabled me to do is not try to hold on to the trade too long, because even if I were to take it as a scalp, i.e. not take it towards expiration, not take it all the way to the end of the day to see it go to zero, I would have been able to take something of significance from the trade because of the size of the initial credit that I had. And so 10:56 held here, tried to press up into 10:60 once more, was rejected, bounced around, toyed with my emotions and toyed with the emotions of market participants at this point, tending to look as if it was going to retest this low of 10:56. It did to some degree. It got to a low of 10:56.80, so within 40 cents of this low that was made over here, but my option never went into the money, nor did my position ever go negative. So this is what also made me confident that the pricing was, the fill that I got was really good, and that would enable me to weather some storms. So because it almost made a double bottom here and the market started to rally, Google went with the market and just basically bounced around. Nothing much happening, no momentum on the upside, no momentum on the downside. There was a bit of momentum coming into, again, that lunchtime period between 12 and 1, and it really went from 1064 to a low of 1058. So in all of that, only about a $4 move for a $1,000 stock, less than 0.004% move in that time. And so I was confident in continuing to hold that this one would have, expired worthless, but I didn't want to take the chance after already having a big gain. You never know what could happen on a Friday evening. The market is sometimes prone to spikes either way, one way or next. And so once I saw this initial bullish bar on that retest, or wanting to retest that low at 1058 down into 1056, from the moment I saw this bullish upwards momentum and the price of my put spread began to decline once again, I sold out of the spread for 35 cents each. So from a credit of $2, which is $200 per contract, for 2 contracts, which would be $400 in total for the trade, I exited at $35, or $70 over the course of the two contracts. And so I was able to gain around 330, not inclusive of commissions and fees. So again, for approximately a 2.5 hour, 3 hour trade, that was more than sufficient for me in terms of my goals and risk to reward ratio. So that's the fifth trade. And lastly, I want to show you something in Amazon that I was also looking at, but I was not able to get a fill on this one. I was not quick on the draw. Well, I attempted to get a fill, but I didn't get a fill at the price that I wanted. And so I just left it. What made me want to get into a trade on Amazon? So Amazon has been fairly strong lately, just like its sister in crime, Netflix. You can see this very strong uptrend it has had. But as of Tuesday, it gapped up over 1670, made a high of 1676. I'll just draw this line right here. Made a high of 1676, but could not hold that, not even for half an hour, and finished at its lows at around 1652. So I began to take notice of this over the course of Tuesday and Wednesday. I saw this area of price consolidation, not really doing too much, but after this extended run of over 200 points, I'm beginning to think, just like Netflix, it should take a pause. It would take a pause. And true to form, on Thursday, it broke down just a tad, rallied back up into this area of price consolidation, which happened to turn into resistance. And so on Friday, I'm thinking to myself, okay, if because of the way the market was setting up, I did not think that it would be a trend day in either direction. I suspected that the market would just bounce around, no momentum in either direction. So I developed the hypothesis, okay, any strength that Amazon has that takes it up into this prior resistance at around 1660, I am going to short. True to form, Amazon opened down weak with the market, had a nice rally upwards into where? Exactly where it was before, at around 1660, this area of price consolidation here. And I tried on 2 occasions to get a fill of the 1670, I believe 1675 short call spread, but I was not able to get a fill, and price fell quickly after this second retest, basically a double top. On the 5-minute chart, and my attention was then diverted elsewhere, trying to get a fill in Google, maybe trying to get a fill in Cigna at the time as well. And so I was not able to get the fill in this trade. I did not try to put it on again, but as you can see, what am I talking about? This is Thursday. It's Friday that we're looking at. Amazon came down, rallied right back up into that 1660 resistance, and the moment it hit 1660, it retreated. And had I gotten that fill at around 1660 of the 1670, 1675 short call spread, I would have literally been sitting pretty all day, because Amazon did not even once meaningfully test that level again. It simply drifted down, and held the low of its range here at around 1638. So this is a good example of using the macroeconomic outlook, i.e. what is going on in the wider market, to then dial down to individual issues and form hypotheses as to what is going to happen, and very nimbly execute what you believe to be the way to go about taking advantage of those particular conditions. And so, all in all, did not do too bad this week. 5 trades, all 5 were positive. I would say 2 of them were for scratches, and 3 of them for decently sized gains based on the account that we are currently trading. And so, once again, thank you for joining me. I hope this was educational. I hope that you were able to understand all of the concepts and the thinking behind why I entered the particular trades that I did. I advise you in your own trading to continue to improve, to continue to learn, to continue to study, to continue to draw information from not just what you think in your mind should happen, but what the wider market is telling you as well. It is a good practice as a trader to continue to measure your effectiveness, measure your win rates, measure your different trading variables so that you're able to pinpoint where you need improvement, what are your strengths, what are your weaknesses, maximize on your strengths, reduce your weaknesses, and or hedge your weaknesses, as we like to say, and continue to be successful in your trading journey and career. So again, this is IslandMint, our weekly trading activity recap, and I want to remind you, as in trading, so goes life. Sophistication in thought, simplicity in execution. Thank you.